All right, good morning, traders. This is your free daily video from seasonalswingtrader.com. We hope everyone is having a great week. Today is Thursday, February 9th, and today we're looking at the bond market. Right now we're looking at the 30-year bond, the March 7 contract. We will be moving into the June contract, which is the next quarterly contract that's tradable on the bonds. That symbol will be ZBM7 or USM7. Right now we're trading the H7 or the March contract. So today's lesson is not going to be more of a seasonal approach. It's going to be more technically based. However, we are somewhat trading somewhat aligned with the overall seasonal bias. I do think interest rates do have seasonal tendencies for sure, and you can see here with the 3 and 5 and even the 10 and 15 years averages have done. So looking out, we're trading mostly somewhat sideways to slightly higher. But like I said, I want to look more technically based for a possible trade in the bonds. So we came down here after the election. We put in a bottom here. We kind of drifted higher. We came back down, doing some consolidation. We did confirm that this is a bottom because we came back down, did not make a new low. Right now we're marching higher. Today, as of this video, we're trading down about 25 ticks or so, so we're retracing just a bit. But the ultimate trigger level here will be at the 154, which will be a break and a close above the number 2 point. If we get that, should take us to a projected target of the 160 level, which would be around 6,500 to 7 grand per contract. The way we're going to look to play this move, though, is going to be in the futures options. And if you can see, so this is a real-time chart here. Like I said, we pulled back some, and we're testing this level here at the 152.15, 152.20 levels. And we're going to look at selling some out-of-the-money put options here, and we're going to look down, way down here at the 145, 146, even maybe the 144 levels, which would take us all the way down below these lows. So if we go over here to the chain and look at the April contract with about 43 days left till expiration, you can see here on the single strikes what kind of premium we're getting here. So the 145s, for instance, we're getting 19, 20 ticks depending on where you got filled. And if you're not familiar with futures options on the bonds, they trade half the size of the actual futures contract themselves. So the 30-year contract trades at $31.25 a tick. The futures options are worth half of that, 15.62 cents per contract. So what does that mean? That means if we sold the 145s here at 19, that would give us a premium brought into our account of $281.25 per contract. So what we would look to do is possibly look to spread this. Now, if you want to trade outright, probably looking around 3 grand a contract, depending on where you go on the chain. The higher you go up, the higher the margin. The lower you go down on the chain, further out of the money, the lower the margin, and hence less risk less premium as well. So if we wanted to stay at the 145s, you'll have to determine what spread or what strikes you want to trade based on your account size and based on your risk. But if we do spread this and we look at the 145s, and for instance, we'll go down to the 140s, we're getting about 16 ticks, so about 3 ticks less than what we get from just selling it outright. And we're going to capture about $250 a contract. Notice it cuts our margin in half to about $1,500, $1,600. But the most important thing is that it caps our risk. So always recommend spreading these, even if it's something way out of the money, you're paying a tick or two, it doesn't really matter. Always spread the risk with something, unless you have a very, very large account or you want to take, you don't mind taking the position. So we always say, look, I'll go down here, sell the 145s naked, which means I'm not spreading it. And I'm okay with that because I don't mind taking a position if it were to come down and I were to get a sign. So we're not looking to get a sign on this position. We simply want to go ahead and start legging in around the 145 level. Could go higher, just depends on your risk tolerance. But I still think that if we were to roll over if the bond market's got weak here, we have plenty of room to be wrong. So we start rolling down. We test the 150 level as a possible support area, then maybe down here at the 149 level, and then if we start taking out these lows at 147, you know, if we're not putting in a double bottom down here, we want to look out for lower prices. But with 40 days left till expiration, we're 7 to 8 handles or so out of the money. It gives us plenty of time to, if we are wrong, you know, we can manage the risk accordingly. The option premium should not inflate too much unless we just got some drastic sell-offs, something like some bars like this. But bonds, you know, the great thing about selling this far out of the money, bonds can drift sideways, even drift lower, and we can still look to profit. Now, we're not trading futures or futures options. We can do this with the TLT, which is the 20-year bond ETF, comparable contract. And you can see same formation because it's going to virtually mirror the 30-year. And we can come over here and look at something similar. The March contract's got 36 days. Probably look at the Aprils here with the 71-day left till expiration. And again, we go down. Where's our support here? You know, the 118 level and then the 117 areas. So if we're looking to place a trade somewhere at or around support, we could take a look and see what the 117s are giving us, and we would look to just spread out. So the 117, 114s are giving us, you know, approximately 60 cents per contract, which is not bad. 60 cents per contract or $60. If we want to tighten that risk up, we could go up a strike and look for 45 or 50 cents on the 117, 115s. Or if we want to make it a 5-wide, we would just go down to the 112s, the 117, 112s, and look to capture about 85 cents or $85 per contract. So multiple ways to play it, whether you're trading the ETFs, the futures, or the futures options. Like I said, we will probably be looking to trade the futures options, and that should give you some ideas for today. Good trading.